Before we begin, please note that this video contains AI-generated visualizations, is strictly for educational purposes, and is not financial advice. Structural growth in financial markets relies on strict alignment. It happens when quantitative models, momentum algorithms, and institutional consensus lock into a stable upward trend. The yearly chart for Aadhar housing points to substantial technical upside, targeting 521 and 555. But drilling down to daily price action, that macro bullish narrative hits a wall. Instead of a breakout, we see a tight, congested cluster of sideways trading. The immediate data presents a contradiction. Primary momentum oscillators are firing strong buy signals, yet the volume algorithms are flashing measurable buyer exhaustion. To figure out which signal is accurate, we have to deconstruct this specific dataset layer by layer and map the exact anatomy of bullish exhaustion. We will systematically test the trend, map the volatility boundaries, evaluate the momentum oscillators, and cross-reference the fundamental value. Defining these critical levels provides the clarity needed to separate a normal sideways digestion phase from a structural shift in the market. We start with the daily price chart. The short-term structure rests on a critical support line at 481.46. As long as price holds above this, the macro uptrend remains intact, confirmed by the 200-day moving average tracking at 489 and the 20-day average at 469. Right now, the daily price is trapped, oscillating between long-term and short-term moving average boundaries. At the 20-day average near 470, price deviates by 18 points, indicating overextension. Buyers push too fast. We overlay volatility mapping. Bollinger Bands reveal a lower limit at 436, a middle band at 488, and a hard upper ceiling at 505. The immediate price candles are heavily pressing against that upper 505 band, physically restricting any further upward movement. We quantify this gridlock using the Munafa value, measuring immediate directional conviction. Today, that Munafa value sits at 55. This confirms that directional momentum has stalled out. The underlying uptrend exists, but the immediate price is trapped in a strict sideways range, firmly capped by these outer volatility bands. To evaluate the buying pressure inside this stalled range, we check the momentum oscillators. This lower pane shows the MACD rising with a green histogram, alongside an RSI line pushing up into the positive zone. Both the MACD and the RSI are currently generating clear, strong buy signals. These overlapping signals create a trap. Traders buying purely on momentum walk into a wall of resistance. We apply the Ichimoku cloud to assess trajectory. The cloud is green, indicating a healthy structural base. Yet the most recent daily candles point downward, back toward the cloud. We measure trend strength using the average directional index, or ADX. Notice the downward slope of the ADX line. That fading ADX clearly confirms a significant weakness in the underlying trend. The actual power behind the movement is evaporating rapidly. Here is the specific paradox: a weakening ADX with a rising MACD. This exact combination signals a fading breakout. The bulls lack the conviction required to push the price through that upper volatility resistance. Relying on standard momentum indicators in this environment creates a false sense of security, masking a trend that is losing its strength. We move from momentum oscillators to actual market mechanics by tracking the volume-weighted average price. This chart plots a bold VWAP line at 484.79. As long as the price holds above the 484.79 average, the bullish bias is valid. But testing that bias, we see the force index dropping into negative territory, aligning with declining vertical volume bars. The force index sinking into the negative zone is a critical warning sign. It suggests that internal selling momentum is taking over. Those declining aggregate volume bars show that institutional buyers have stepped away from the asset at these levels. The stock is currently suspended in a precarious position. It lacks the volume support required to sustain a breakout. So if the aggregate volume has completely evaporated and the upward momentum is entirely trapped, why hasn't the asset's valuation completely collapsed? The answer lies in the underlying fundamental valuation, which acts as a structural floor keeping the asset afloat. Aadhar Housing reports an earnings per share of 23.80, matched against a price-to-earnings ratio of 20.53. Furthermore, the company delivered a profit growth of over 22% quarter over quarter. This performance provides a valuation-based rationale for the long-term moving average support levels. The data suggests that the asset's underlying value is effectively absorbing short-term selling pressure, keeping the price anchored to its long-term support levels. Bringing all these disparate data layers together gives us a complete, unified predictive model. This master chart maps the structural support at 481, the VWAP line at 485, and the upper Bollinger Band at 505. The immediate reality is clear. Aadhar housing is locked in a high-tension digestion phase. Buying blindly on momentum near that 505 upper band without volume confirmation carries a high risk of rejection. Instead, the actionable trading zone is tightly compressed into the space between the short-term VWAP support and the upper volatility boundary. Despite the short-term exhaustion, the long-term structural setup remains intact. This sideways price action is a necessary base-building phase, provided the 481.46 support level continues to hold. For the next major leg up, an attack on those 520 and 555 yearly targets requires aggressive volume to re-enter the market. True quantitative edge lies in reconciling these contradictory timeframes. When you map the exhaustion, you separate the technical noise from the structural value.